Prepare for a melt-up rally. The words from Tom Lee, a top Wall Street strategist who does appear on CNBC from time to time. And this is after the last 30 days where we've seen some very strong gains in the S&P overall. We've had nearly every single semiconductor up double digit, notably Nvidia up 21%. We've seen the likes of Google and Meta also up 15 and 17% respectively, although we have had some companies, and for perhaps good reasons, not perform as strong. United Health down 22%. As we've covered many times on the channel, lots of issues that have been ongoing with the company that have seen investors start to get a little bit scared, and maybe surprisingly, for the large part, Berkshire Hathaway down around 5%, a very rare case that we don't typically see, one that has continued to outperform the market. Now, you could argue most of that drop is, as we heard last month, Warren Buffett stepping down, but there's also a case to really see no issues with the company. They continue to have record piles of cash, higher numbers pretty much every single quarter, and even after this very strong run we're having in the last 30 days, investors are still sitting in greed, sentiment is very high, many continue to buy every single day, every single week, and even after all of that, as we can see, Tom Lee calling the V-shaped rally among the most hated ever as the market is near all-time highs. He also believes that we're just getting started, the party is only beginning, as he says there is a possible face ripper surge on the way. Now we can see since 2020 this is the third most hated rally, and we're only a few percentage points away from a new all-time high in 2025, something no one would have seen coming around Liberation Day, where we did get some significantly large drops right across the market. Now his targets do however still stand for the S&P. He believes we're going to end the year around the 6,600 mark, which does currently equate to around a 10% gain for the S&P till the end of the year. Some investors will like that. Others who are a bit more risk-driven will perhaps be looking for stocks that can continually outperform the S&P. And if you remember from a few months ago, he also said that the face-ripping stock market rally has already started, in which he attributed this push really down to Tesla carrying the market forwards. Now you could argue some external factors may have caused a bit of a dent in this theory, as we've seen just over the last few days. Donald Trump and Elon Musk have really been going at it, and it does look like, according to Donald Trump, that the relationship that these two had is now officially over. But if we get back to Tom Lee and his vision moving forwards, we can see here he believes we're in what we just highlighted as the most hated rally. We've got bearish sentiment keeping many investors on the sideline, despite what he believes is improving fundamentals across the board. 7 trillion, as we can in fact see, just waiting to be deployed. And with the recent short interest that we are noting from hedge funds, this will only, in his opinion, add fuel to a larger upside potential. Now, if we do compare that to earlier in 2025, he notes that there is better visibility around tariffs, tax, and Fed policy, as well as US companies who are now starting to prove a lot of resilience through multiple different stress tests. Now, in the episode, we are going to cover some of the companies that he believes has the most upside to really excel in 2025 and even into 2026. But at a very high level, he points out to washed out stocks, which we're going to cover shortly, the Mag 7 and Bitcoin, even after the run both of these have had, industrials, financial in terms of large cap and regional banks, as well as small caps, all really now primed for a very strong run moving forward. And if you just want to understand what washed out stocks technically means, well, we have here market caps of below $15 billion, ones that have dropped around 30% or even higher before February the 18th, those that didn't make any new closing lows around that Liberation Day period, and are down at least 25% from their 52-week high, with a short interest day to cover more than 2. Now, some of these notable names, we have Wall Street Boots Alliance, Southwest, Rivian, Roku, TMTG, SoFi, and Crocs, of, as we said, we are going to get into a little bit of detail, but it's also alarmingly present that if you are looking at companies solely on a valuation, they continue to be trading at some high levels, hence why we see a lot of red. Now, if you're interested, this is based solely on a forward P. We also have, for those that want to incorporate companies that whilst trading at high valuations are also growing as such, we have the PEG, the price to earnings growth. Again, many companies in the red, although you may be surprised to see Nvidia and Google looking fairly reasonable at the 1.5 mark. And the same can be said whether you look on a price to sales or in fact a price to book. Conclusion remains to be the same throughout. Regardless of what analyst or Tom Lee is saying, companies do seem to be treading on a little bit of thin ice in terms of their current valuation, but as always, we need to do our own due diligence when considering individual stocks. Now today we're going to run through 7 of them, and the first one is Crocs. Now you probably are thinking about this company, whether you like it or not. One thing we would say is just to take a look at their metrics. They do look fairly strong, as well as some very significant upside and margin of safety. Starting off, the company is down 32% over the last year. Year to date, down nearly 8%. And if you've been holding this company over the last 10 years, you would have massively outperformed the S&P, up 567%. Is also worth highlighting is trading near the 52-week low, and both Seeking Alpha and Wall Street give it a fairly respectable 4.2 out of 5, a buy rating, with a forward valuation looking pretty low in isolation, sitting at the 8 mark. Now if we look at the metrics at a very high level, their sales over the last 10 years have quadrupled, very strong, nice to note. They've been doing share buybacks, which is always one way management return excess cash to investor pockets, again very positive to see. Return on invested capital, very, very high, nearly double digit every single year. And remember, on the channel, we want to see a bare minimum of 10% to give us faith management are able to effectively allocate their capital, so looking pretty strong. We see margin efficiencies improving over the longer term. 10 years ago, negative 4%, they were loss-making. Now it's been steadily increasing, sitting at 25% on a trailing 12-month. The same to be said for the free cash flow margin, increasing, sitting at 22. Again, these are some very strong and respectable numbers, whilst also highlighting the net debt to EBITDA, probably the only metric we want to see decreasing, is doing exactly that, sitting at 1.37. Now remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. Very strong balance sheet based on this metric, as we want to see a maximum of 3. And their valuation grade in fact gets a B. As we highlighted, the forward P sits at 8. The sector does sit a lot lower at 16.5, meaning you're getting a 51% discount to the overall median. And in terms of their own 5-year average, you're also getting a 41% discount. Conclusion, for the large part, does remain pretty similar. You are, as an investor, getting a significant discount to both sector as well as their 5-year average. However, where they do lack is in terms of their growth at a D-, both year on year and forward looking, sitting around the inflationary rate of 2 to 3%. That is the same as the sector, so growing pretty much in line. However, over the last 5 years, this has been a company that has seen some tremendous growth on their top line. EPS, probably where this company does lack, 3% projected over the next 3 to 5 years, below significantly both sector and their own average, 10 and 8% respectively. Now before we jump into our own valuation, worth highlighting that over the next 4 quarters they're actually expecting a decrease to the EPS, but they have outperformed fairly significantly against analyst targets, 100% track record, and they're trading on 2026 numbers at a forward P of 7.7. Now our intrinsic value for Crocs gets to $230. This is derived from the discounted cash flow. We have the free cash flow year on year. Most recent increase sits at 13%. Average sits at 103. Now moving forwards, we've gone incredibly conservative to just show you the upside in MOS at 0%. That is the low rate, where we have a medium and high at 2 and 4%. Remember, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Crocs or any others. But at 0% and the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, $230, indicating 128% upside. Now for full transparency, we'll show you at the 2% rate that you are seeing the price at 270, upside of 167, and at 4% this comes to 317, indicating 214. Now we want to be extremely conservative. Bear in mind, this is if they don't increase their free cash flows anymore. It stays flat at 923 over the longer term. And what we do here is we always like to apply a margin of safety, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Now, if you believe that in today's episode, a buy at $207, then we keep going till it's near the current price. And as you can see, a very, very large margin of safety for the company. In fact, you're getting at least 50% up to $115. And as we keep going, not at 60% just yet. At 55 is where we see this right now. Remember, forward P sits around the 8 mark. Wall Street themselves, they see this at $140 over the next year, translating to 39% upside. So stock number one, as we highlighted, one of Tom Lee's washed out stocks that he does believe will see explosive upside. MOS 55%, upside 39%. Give us your thoughts whether this is one you would consider, or perhaps you don't believe in the longevity of the brand and you do believe competitors will really wipe away a significant portion of their top line revenue. Now, before we continue, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning completely for free to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of June. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can also grab a copy of 19 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock is another washed out one that Tom Lee believes in over the longer term. That is SoFi Technologies, up 101% over the last year. Year to date though, it is down around 8%, and we can see currently trading in the mid to upper end of the 52-week range. We did cover this not that long ago, where it was trading around the $12 mark, so already in just a matter of weeks it has gone up fairly significantly, but we do just get one buy rating from Seeking Alpha, and worth highlighting, unlike Crocs, the forward PE does sit significantly high at 51. This is also a company that continues to increase its members every single quarter. Just at the end of last year, they did break the 10 million barrier, and in their most recent earnings, we did see growth of 20% to their top line, as well as nice to see their fastest growing revenue stream, financial services, up 101%, as well as strong growth to both members, up 34%, and their products up 35%. As we said, the forward PE does sit very high. In comparison, the sector sits a lot lower, so for SoFi Technologies, you're paying a 377% premium, but their growth, at least for the large part, looks a lot better than what we note from the sector. They get an A year-on-year 24%, pretty much the same expected moving forwards. The sector in comparison does sit in the mid-single digit, and over the last 5 years, they have been growing at a much faster rate. EBITDA growth also looked to be very strong over the next 12 months, 43%, sector at 11%, but again, over the last 5 years, this company has grown at a faster level. As we highlighted, they did have a strong quarter 125 and in fact a 100% historical track record, with 3 of the next 4 quarters anticipated growth to the EPS. Next quarter, in fact, 493% projected. Whilst for those that do believe valuation is very high, if you look at it based on 26 numbers, they're trading at a forward P of 27.8. Now our valuation gets to just under $16, where likewise from the previous company, we've used the DCF model. At a 10% growth rate moving forwards, we see 13% upside. For those that actually believe 8% to be more accurate, we can see already baked into the numbers right now, given the price isn't that dissimilar, is 8% moving forwards to the future free cash flows. If you believe it is about right, that is reasonable, then right now it is trading at its fair price. If you see it should be lower, then actually overvalued, and if you see it higher, for example, at the 12% rate, then there's upside of 29%. As we said earlier, typically we take through the medium rate, 10% right now, using a margin of safety, you're getting pretty much bang on 10%. And whilst Tom Lee sees this as one of those stocks that will go up very high, very explosive very soon, Wall Street themselves have this at $14.50 over the next year, translating to very limited upside at 2%. And for those that are newer to the channel, well, what we have historically done for entertainment purposes only, if you believe they can get to the market cap the size of PayPal, then over the longer term, the price will be around the $80 mark, indicating 458% upside. As always, give us your thoughts about these stocks. Is SoFi one that you're an investor in, maybe one you're considering, or in fact just isn't right for you? We then move into the industrials, which was one sector that Tom Lee does believe is ripe for massive growth. We have FedEx Corporation down 12% over the last year. Year to date, down 22%. Over the last 10 years, big roller coaster, up only 20 though from 10 years ago today, and it does trade near the 52-week low, but we get a double buy from both Seeking Alpha as well as Wall Street, and we do get a double undervaluation signal as the forward P of 11.3 does sit below the 5-year average of 13, as well as the yield on offer to shareholders at 2.51, sitting above the 5-year at 1.92. These both tell us undervaluation. And that's also confirmed when we take a look at this model, blue tunnel reflecting the fair price as we see it outside of even the bottom end disparity noted. That in itself is another undervaluation signal. Valuation grade though does look good at a B. What this highlights, the sector does sit a lot higher, so you're actually getting a 38% discount overall, and against their own 5-year you're also getting around 12%. Again, pretty much for the majority of metrics, that is why we see the A and B rating. You are getting a discount quite severely against both sector and their 5-year. Growth does lack quite significantly, in fact, at a D, pretty much flat year on year and forward looking, when the sector, whilst not much greater, is pretty much in line with inflation, and their own 5-year actually does sit a lot better. Earnings per share though, they're projecting around 9.2% growth, which whilst does look good in isolation for the company, is below both sector and their 5-year around the 11 to 12% mark. Finally, over the next 4 quarters, they're projecting every single one to be growth. Great to see. Next one double digit, but they do have a 50% track record. Most recent quarter was a miss by 11 cents, trading on 26 numbers at a forward P of 10.9, and our intrinsic value, which is just the average of these 4 models that you see on screen. Remember, as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for FedEx or any others, is going to give you a fairly attractive margin of safety. As we keep going, you're getting at least 20% up to 229, 25, not far off, so you could argue 25% MOS at 215, as well as projected 28% upside. Fairly attractive starting yield as well. Wall Street see this at 280 into 2026. We then move into the Mag 7, one of the cheapest valued on a forward PE, that is Meta Platforms, up 41% over the last year. Year to date, up nearly 20%, and over the last 10 years, massive outperformance of the S&P, up 756%, and some investors may have actually bought that very low point October 22 at under $100. You'd be up fairly significantly. As of now, it's trading near the 52-week high, a strong buy rating from Wall Street, a buy from Seeking Alpha. However, we do note the forward P does sit significantly above the 5-year average, 28 versus 23. That in itself is one potential overvaluation signal, and that's reconfirmed as we do in fact see it slightly above even the upper end, but nice to see the expected fair value has been increasing over time, just not too good to see a potential overvaluation signal. Grading also gets an F, as we note the sector sits a lot lower, you're paying a 105% premium, but as we just highlighted, they're also sitting higher than their 5-year, around a 17% premium, and again, conclusion remains to be the same, premium on both accounts. Growth does look good though at a B-, year on year 20%, forward looking around 17%, well above the low single digit of the sector, and also pretty much in line with their own 5-year average. Earnings per share expected to be very nice at 18%, given the sector sits lower at 11, and also a tad higher than their average at 17.4. They do, however, only anticipate one of the next 4 quarters to be growth, with a 100% track record, some very sizable beats, $1.22 in the most recent quarter, trading on 2026 numbers at a forward P of 24.5. Now our intrinsic value gets to $700, which as you can see straight from the off pretty much tells us we believe this company as of today is trading bang on its fair price. Now we have derived this from the DCF model using a 10% growth rate, which tells us as of today already baked into the numbers moving forwards for Meta is 10% growth to their future free cash flows. If you believe it should be higher, well 12%, 15% upside, and for those that believe a lot higher at 14%, 33%. Using 10%, what this essentially means is that there is no margin of safety, but if you're interested at 10%, a buy at 630, at 15 around 595, at 20 around 560, and at 25 525. Wall Street also in agreement. Whilst we do get a strong buy rating, it is a bit confusing given upside sits at 0%. They see this at $700 into 2026. Give us your thoughts. Maybe you believe this is actually a good one to just continually dollar cost average in. Continuing to the Mag 7, we have Nvidia up 17% over the last year. Year to date, they're actually positive, up 6%, something that maybe wasn't a foregone conclusion when we were sitting around the Liberation Day lows. Over the last 10 years, massive outperformance of the S&P, up 26,754%, trading in the upper end now of the 52-week range. Strong buy from Wall Street and a buy from Seeking Alpha. Surprisingly or unsurprisingly, it still looks severely undervalued. Forward PE 29.6 when the 5-year sits at 43, and that's also confirmed on this model. Great to see the blue tunnel increasing and fairly sharply, but nonetheless we get disparity between the 2 points, another undervaluation signal. Again, might be surprising given the strong run this company's been on in the shorter term. Now in terms of grading, they get an F as they do trade at a premium of 46% to the overall sector, but I'm fairly confident many investors will agree it deserves a premium against their own 5-year average, as we've highlighted, also trading at a discount of 30%. But conclusion remains premium against the sector, but actually a bit of a discount against their own 5-year average. Growth looking good at an A, year on year 86%, forward looking 60, significantly above the sector. So yes, they do deserve a premium, but also they're growing their revenue at a much faster rate than their own 5-year average, and this also holds true for their EPS. 29% projected when the sector sits at 14, and their own 5-year lower, although marginally at 28.5. No surprises, green right across the board, 100% track record, but also expected double-digit growth to the EPS over the next 4 quarters, trading on January 2027 numbers at a forward P of 24.7. Now our valuation gets to $164, where we have selected a median rate of 20%, but you could argue that is fairly conservative, given the 5-year sits at 153%, 10-year sits at 104%. Nonetheless, if you do believe we should use the 25%, which we have today selected as the higher rate, intrinsically 229, indicating 61% upside. If you believe it should be low at 15, 116, which does tell us a downside of 18%. So using the median rate of 20%, you are still getting a margin of safety for Nvidia. As we keep going, 10%, buy at 147. At 15, not there yet, not too far off. So for the AI giant, we would say near 15% MOS. Wall Street themselves, strong buy rating, $165 price target, 16% upside. As always though, let us know your thoughts, whether you see this one, like Tom Lee, as a strong buy, like the analyst as well, indicating a very good opportunity, or perhaps a different opinion. We also have Alphabet here, down 2% over the last year. Year to date, down 8%. Over the last 10 years, still with the drops we've seen, outperforming the S&P, up 534%. Trading bang in the midpoint of the 52-week range. Double buy from Seeking Alpha and Wall Street. Wall Street 4.41, not far off the 4.5 to flip this into a strong buy. Still showing signs of undervaluation with a forward P of 18.8 given the 5-year sits at 22. And this is also reflected when we take a look at this model. It is increasing over the longer term, but disparity is getting smaller and smaller. May not be long before this undervaluation signal does get into the blue tunnel and turns into a reasonable level. Growth does get a D-, sector trades a lot lower and you are paying a 36% premium, but similar to Nvidia, this one does deserve a premium to the overall sector, and against their own 5-year, as we've highlighted, trading at a lower valuation, 27% discount. Again, conclusion pretty consistent no matter which metric you look at. Growth comes in at a B-, year on year 13%, forward looking at 12, well above the sector at 2 to 3%, but actually growing their top line a little bit slower than their 5-year average. In terms of EPS, projected 15%, well above the sector at 10.8, but we actually see it lower than their historical at 17.9. Now they do expect 3 of the next 4 quarters to be growth, 100% track record, and trading on 26 numbers at a forward P of 17.1. And our valuation gets to $200, derived from the DCF model using a growth rate of 10% moving forwards. Average over the last 10 years has been 20. Most recent year, in fact, sits at 5%. And you can note low, medium, and high 8, 10, 12 respectively. So this pretty much tells us if you do think we are using a very high rate at 8%, pretty much bang on the market value. Already baked into the numbers then is 8% growth to the future free cash flows of the company. So at 10%, you are still getting a margin of safety. If we were to use the first level, you're getting $180 as the acceptable buy price. At 15%, not far off. So again, very similar to Nvidia, we notice Google has a near 15% MOS, Wall Street themselves, again, very similar to the AI giant, $200 price target, which as we can see translates to 16% upside. Worth letting us know, perhaps between two companies that do look very similar in terms of the numbers, the upside, the margin of safety, is Google or Nvidia the better bet moving forwards? We then get to Amazon, which is up 15% over the last year. Year to date, down around 3%. Over the last 10 years, massive outperformance of the S&P, up 894%, trading in the mid to upper end of the 52-week range. Double strong buy from both Wall Street as well as Quant, and a buy from Seeking Alpha, trading at a forward P around 34.5, and we notice their valuation sits well above the sector. You are paying a 109% premium, but over the last 5 years, they were sitting at a much higher valuation. You're getting an 81% discount. Again, conclusion remains massive premium to the overall sector, but you are getting a discount for the large part to their own 5 year. Now, their growth sits at an A- year-on-year revenue and forward looking at the 10% level, when the sector does sit in the low single digit, but they've also been growing their top line at a much faster rate on a historical basis, with EPS growth expected 17%. That is great to see given the sector sits at 10, but we also note over the last 5 years growing much faster at 31. Now, over the next 4 quarters, they are anticipating 3 of them to be growth, 100% track record, trading on 26 numbers at a forward P of 29.5, and our valuation today comes to $230, where we have used the lower growth rate of 20%, where you can see 8% upside. For those that believe it should be higher at 25, 52, and at 30%, which is very high, 112%, pretty much a double from today. So using the lower rate of 20%, in terms of a margin of safety, one which you are still getting, at 10%, a buy at 207, not quite there yet, so we see around 5 to 10%, one of the smallest in the episode today in terms of MOS, with Wall Street seeing this at $242 into the next 12 months, upside of 13%. Give us your thoughts on Amazon. Does it look like, as we can see from both Tom Lee and Wall Street, as a strong buy, or maybe one you are starting to consider, or maybe one you don't believe is right today? Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all in the next one.